This is Money Talk on News Talk 580 CFRA. Here is John Budden.
Good afternoon, folks, and welcome to Money Talk. I'm John Budden, and here's the lineup for today's show. We start with Dave Sally of the Ottawa Business Journal, and then Canadians are most evenly split on whether ensuring good trade relations or China's human rights record is more important when it comes to foreign policy with China. That's according to a new Nanos research poll. But does it have to be one or the other? Sarah Koudalakos, who is Executive Director of the Canada-China Business Council, says making human rights part of trade arrangements is the key to strengthening business ties between the two countries. After a break, we go to my interview with John Embry, who is a senior strategist at Sprott Asset Management. And then after the news, part one of Michael Hainsworth of our affiliate BNN's interview with David Prince, who is the founder and president of Harbinger Capital Markets. And he comments on the decline in U.S. jobs, well short of expectations as wage growth slows in the United States. Then part two with David Prince, looking at the Canadian economy that posted a brutal second quarter GDP print as manufacturing failed to offset the pain from Alberta wildfires. After the final break, we conclude with Rob McClister, founder of RateSpy.com, and he talks about how attacks on foreign homebuyers sunk Vancouver's real estate prices. But first, we go to Dave Sally with the Ottawa Business Journal. It's good to be joined by Dave Sally of the Ottawa Business Journal. How are you, Dave?
I'm pretty good, John. How are you?
Okay, looking forward to the weekend. I'll have to confess that this is Friday, and we're heading into the Labor Day weekend, and I hope you have a fun time.
Yes, well, same to you, John. I'm just hoping to relax and enjoy the last long weekend of the summer.
Now, the city's hotel industry is gearing up for what it says historic year in 2017. While a well-known local fitness chain got a boost of strength from new investors this past week, and Ottawa City Council put new restrictions on illuminated business signs.
That's right, John. Well, let's start with the local hotel industry, which is expecting a banner year in 2017. Visits to the capital are expected to increase by about 20% next year. Of course, that's due to Canada's 150th birthday celebrations. And managers at downtown hotels say that's already translating into a steady stream of bookings, and not just for the Canada Day weekend. Ross Meredith is the general manager of the Westin Ottawa. He says potential travelers are showing plenty of interest in staying downtown throughout the entire summer, not just on July 1st, and he's expecting 2017 to be a record-setting year for his hotel. He says the Westin also has conference bookings that happen to coincide with Canada Day, and as a result, the property is already completely sold out that weekend. It's a similar story at other downtown hotels. The manager of the new Andaz Ottawa Byward Market Hotel says it's already received tons of inquiries about reservations, not just for Canada Day, but also for events such as the Juno Awards and the Grey Cup, which are both taking place in Ottawa next year. Now, prices at many hotels will likely go up during peak times as a result of the increased demand. But Steve Ball, the president of the Ottawa-Gatineau Hotel Association, says there are still plenty of rooms available for all the 2017 events, and he advises travelers to book as early as possible to get the best rates.
Meanwhile, a major Ottawa-based chain of fitness studios has announced new funding, a change in management, and plans to expand.
That's right, John. Well, many gym-goers in Ottawa are probably already familiar with the name Greco Fitness. The company currently has 14 locations in the city, as well as one in Toronto. This past week, the chain announced it has landed new funding from a group of investors that includes New York-based Integrity Square, a firm that invests in health, fitness, and outdoors companies. The deal will also see David Fowler, a former executive at Integrity Square, lead Greco's new management team. Greco is set to open another new studio in Laval, Quebec soon, and is eyeing further expansion in Toronto, Quebec, and the northeastern United States. In particular, it's looking to expand into cities with NHL teams in the hope it can leverage co-founder Tony Greco's history of training pro hockey players. Among the NHLers who've worked with Mr. Greco in the past include Dan Boyle of the New York Rangers, Nashville's Mike Fisher, of course a former senator, Claude Giroux of the Philadelphia Flyers, and recently retired Senators defenseman Chris Phillips. Mr. Greco will remain the largest shareholder in the company. He will also sit on the board of directors and act as a brand ambassador for the chain.
And finally, Ottawa City Council has made changes to the city's business sign bylaws.
Yeah, John, that's right. Ottawa businesses will now have to obtain permits to put up new illuminated signs in their storefronts. That's after City Council approved a motion making changes to the city's existing permanent sign bylaw this past week. Now, the illuminated window signs that are already in existence will be grandfathered in, but any new illuminated window signs will require a permit. The changes also ban flashing signs and strobe lights and set limits on brightness, particularly for digital signs. Illuminated signs in what the city calls heritage convention districts, areas such as the Byward Market and Lower Town, will face further restrictions. Such signs will only be allowed in those areas if they have an external source of lighting, according to a report prepared by city staff. Meanwhile, businesses in rural areas will be able to put up bigger signs than were previously allowed, and large shopping centers will also be allowed to have slightly larger signs under the changes. Businesses on Preston Street between Somerset and Albert will be temporarily exempt from the changes due to the fact that each block in that area has very specific zoning and zoning exemptions. New rules for signs in that area will be drafted and presented at a future planning committee meeting. A section of the bylaw that would have allowed more billboards in Ottawa was removed, maintaining a rule that bans billboards from being less than 150 meters apart.
And Dave, what's on the OBGA radar for this week?
Well, John, speaking of hotels, the Andaz Ottawa Byward Market is hosting its grand opening party this coming Wednesday. The brand is marking the launch of its first hotel in Canada with a multi-floor celebration of Canadian art, design, and fashion, including a signature drinking and dining menu from chef Stephen LaSalle. OBJ will be on the scene and will have a full report with a photo gallery on obj.ca.
That's a great update. Thanks so much, and we'll look forward to having you join us again, same time next week, Sunday, 2 p.m., and have a great holiday weekend.
You too, John. Thanks.
And now we go to our affiliate BNN, and John Ehrlichman, who is in conversation with Sarah Koudalakos, who is Executive Director of the Canada-China Business Council in Shanghai.
Canadians are almost evenly split when it comes to ensuring good trade relations or China's human rights record as being more important on the foreign policy front with China. That's according to a new Nanos research poll. Does it have to be one or the other? Our next guest says making human rights part of trade agreements is the key ingredient to strengthening business ties between Canada and China. Joining us from Shanghai is Sarah Koudalakos, the Executive Director of the Canada-China Business Council. Sarah, thanks for joining us. And just as we sort of think about some of the things that have come out of this trip, we've highlighted a lot of the trade agreements. How would you describe sort of the business ties between these two countries at this point?
Well, I mean, the business ties are good, but they are not as good as they could have been because engagement at the top has been lacking over the past few years. And the temperature at the top sets the tone for much that happens in the business community. It essentially provides headroom. A warm relationship at the top gives the business community headroom to move forward. We find that Chinese partners are more willing to deal with Canadian companies. We find that approvals for investments and, many of the administrative things that need to happen in China just go more smoothly when the relationship is going well. And that's why the Prime Minister's trip this week is so important. And the fact that it appears to have gone very well and a warm relationship has been started is really crucial. And last night, the Prime Minister spoke at a dinner hosted by the Canada-China Business Council, and he stressed in his speech that China matters and that it's irresponsible not to engage with China. And he made particular note that it's a really long-term game. This isn't just a one-shot deal. And so the fact that he's taking a long-term approach to it and trying to develop very productive relationships we find a very positive sign.
I hear you saying that this is a different approach than what we saw at the top before Justin Trudeau was Prime Minister, so meaningfully different from Stephen Harper. Is that the correct assessment?
I think, there wasn't the desire to engage in the same way from the previous government. There was much good done by the previous government. However, between 2012 and now, there was definitely a very chilly environment. And the fact is, as you noted in your polling numbers, the Canadian public is somewhat reticent about China. But the fact is, China is a very important part of our world. And even if you're a Canadian company doing business in Cleveland, you're going to encounter Chinese companies. They might be competitors, they might be partners, but no matter where you go, you're going to encounter China. So making sure that we understand China, that we have a strategy for China, and that we bring China in on all of the important multilateral issues in the world is important. And you can't do that if you don't have a strong political relationship.
With respect to the sort of early discussions tied to a real free trade deal between these two countries, obviously the Prime Minister was asked about it this week. It would come up, and it's something that, there is a preliminary process behind. What's the roadmap towards whether that becomes some reality?
My suspicion is that a free trade agreement, or whatever we may decide to name it, will take time. Both sides want to make sure they thoroughly understand their own interests, and the previous work that had been done as a precursor to FTA negotiations came out in 2012. 4 years in China is a long time. A lot changes, and so I think that whether or not a free trade agreement gets negotiated, and if and when it does, it won't be immediate. But I think the one thing that's important to point out, because the media has been really fixated on things like human rights, and even within issues like free trade agreements, the key is that if you have documented agreements with things to measure and things to follow up on, it really helps to keep everybody on the same page. One of the challenges that there's a paper done by Pittman Potter and a longitudinal research project by Pittman Potter at the University of British Columbia, and one of the points that he makes very well is to say China actually has all of the proper laws on its books that should be being followed, but it often isn't following them in the same way we might expect them to. So by setting mutual expectations through things like free trade agreements, it makes it that much easier to progress.
All right, Sarah, thanks for your perspective. A very busy week for sure. Sarah Koutoullakos is the Executive Director of the Canada-China Business Council, joining us from Shanghai.
Stay with us, folks. We're going to a break, but when we come back, my interview with John Embry, who is Senior Strategist at Sprott Asset Management, and you won't want to miss it. You are listening to 580 CFRA.
You're listening to Money Talk on News Talk 580 CFRA.
Well, it's good of John Embry, who is a Senior Strategist at Sprott Asset Management, to join us on this holiday weekend. How are you, John?
I'm excellent. It's very nice to talk again, John.
You and I tried to talk about one of our favorite subjects, meaning the precious metals markets, when there has been a consolidation. So hopefully it's an opportune time for people to pay attention to both gold and silver. Gold has been up close to $1,400 U.S. an ounce, and it backed off to almost $1,300 U.S. an ounce. And I would like to start with your overview on the situation since we last talked.
I think there's a great deal of pressure building up under gold, which is going to take it materially higher in the fall. Things are very slow in the summertime, and basically there was pressure on gold for no apparent reason. So I think that you're going to see a lot of activity in the fall, and I would be very surprised if it weren't to the upside.
Well, before we started this discussion, you and I were comparing notes and determined that we together have about 100 years of watching the precious metals markets. And we, of course, went through the 1970s, which is ancient history for a lot of people. But we learned a few lessons, and we know that gold can have, and silver can have, quantum moves, and that the situation then was much better than it is now. For example, there just weren't the derivatives positions around, and there wasn't the ongoing battle between paper notional gold and physical gold, and likewise for silver.
Well, the other thing that you didn't mention that is vastly different from the 70s is the amount of debt in the system globally. I mean, it ensures, I believe, a destruction of the currency system as we currently know it. And as you're well aware, John, at that point, that's when gold comes to the fore, because it represents real money, and it will be seen as an alternative. And I think we're getting closer and closer to that day.
There are so many markets that are at all-time highs. The bond market is, in effect, at probably an 800-year high with interest rates negative, which they have never been before. You have stocks that have been elevated because there are no returns in fixed income and people have crowded into equity markets. So the precious metals markets, besides being real money, are really a terrific alternative and cheaper alternative to some of these other markets that have gone to incredible excesses.
I totally agree. I mean, as you mentioned earlier, there's been two massive bull markets in gold and silver since 1971. The first one saw gold go from $35 to $8.50, and then the second bull market in gold saw it bottomed around 2000 at just over $250 and saw it go to $1,900. Now with gold sitting around $1,320, I suspect that before this is over, and this is a strong statement, I believe this will be the biggest bull market. It will exceed the previous two bull markets because of what we were just talking about, derivatives, debt, just a lot of insoluble problems in the world.
Now, shares during the past couple of months, during the summer, have corrected from their high levels, and people should consider having a complement of physical metals and shares, and I wonder if you could speak to the share market.
Well, the share market had a spectacular rally off of, a very cheap bottom in the middle of January. At one point, the Huey Gold Index, which I think is a very representative index showing what gold stocks are doing, I mean, it went up from bottom to top 180%. Now it's checked back around just over 20%, and it seems to be getting a little life again. I think this is a wonderful entry point, particularly if what I just said earlier, that the gold price is going to start to perform better in the fall. I suspect the shares, gold goes up, if shares go up that much more. So I think it's a great opportunity to get into the shares again because we've had a nice correction. And I would encourage people to look very closely at this.
And some of the big players, most recently we've heard that Deutsche Bank seems unable to deliver the physical metal against paper contracts. And I wonder if you could give your thoughts on that. It's enough to make one a little bit conspiratorial.
I can't emphasize enough how important it is that you know what gold vehicle you own. I mean, obviously the safest is to have physical gold bullion in your possession. Or failing that, if it's not in your possession, it's in a vault which you know is safe. But if you own a paper gold vehicle, I think it's absolutely essential that you understand exactly what that paper gold vehicle is. Like, I can guarantee you, for example, at the Sprott Physical Gold Trust, all the gold is there in the Royal Canadian Mint, and it is a very safe, fully backed vehicle. But I can also tell you that a lot of things that are masquerading as ETFs and that as gold, but most of them don't have the gold backing, and the very time you're going to need that gold, that's when you're going to find out that the gold isn't there in these vehicles. And that Deutsche Bank example you just cited is a perfect example of the problem. That these people said that, you could come and get your gold anytime you wanted. And guess what? Somebody went, and no, you're not getting it. That has been revoked. So no, there's an awful lot of paper gold in the world that is nothing other than paper.
Well, listeners may think that you and I are a couple of vintage gold bugs, which is pretty accurate. For the average investor who takes some of the things that we're saying and wants to add some protection against devaluation of currencies and rocky equity markets, a 10% or 15% weighting in good quality gold and silver shares and also bullion makes a lot of sense, doesn't it?
I think it's absolutely essential, made more essential by the fact that most people have no exposure. And so consequently, when this becomes obvious that this is a good idea, and it isn't obvious to most people yet, that you're going to see an explosion in the prices because there could be so much money out there chasing so little product. So consequently, I mean, if you share any of our concerns, John, anybody out there should have a minimum of 10 to 15%. And if you believe 100% in what our concerns, I think you should have a much higher component today for the very simple reason that the alternative assets, bonds, stocks, and real estate, are on the moon. They're grotesquely overvalued by any historical measurements.
And these are some of the few assets available to provide protection that are relatively cheap.
They're the only really cheap assets, because you can get into all sorts of things like diamonds and art and what have you. And they're very expensive relative to where they have been, whereas gold and silver are just crawling along the bottom. So I can't emphasize enough how important this is, and that people must take advantage of this opportunity. But we'll see. It's falling on deaf ears, that message.
Well, at Sprott Asset Management, you have physical funds, both gold and silver, with the gold and silver stored at the Royal Canadian Mint, and there are some very good equity vehicles, and also you've got some exchange-traded equity vehicles that trade on the New York exchanges. So people should talk to their investment advisors and determine the weighting. I guess if I had any influence, I'd suggest that they increase the weighting given the dire situation that is looming in terms of possibly a currency reset.
That's very good advice, and as I said earlier, I mean, most people have no exposure. And this will be seen as a mistake. Like, think back to when we were in the 70s, John. I mean, if you had a 10% exposure in that era, that offset everything else that was going wrong with your portfolio. I think things are more dire this time, so I can't encourage people enough to have some meaningful exposure to this sector. And they're cheap. Both the bullion and the shares are relatively cheap compared to anything else.
Well, that is a superb update, and thank you for joining us on this holiday weekend, and we'll talk again soon, John, and take good care.
It's my distinct pleasure to chat, and I hope we can help the people.
We'll go to the news, and when we come back, Michael Hainsworth, our affiliate BNN, talks to David Prince, who is the founder and president of Harbinger Capital Markets Research. Stay with us. You are listening to 580 CFRA.
Now back to Money Talk on News Talk 580 CFRA.
Jobs growth south of the border faltered last month. The U.S. economy falling well short of those 180,000 net new positions we were told to expect. What does this mean? Perspective from Harbinger's David Prince now. Hello again.
Hello.
Feels like forever since we've spoken. Well, what do we got? About 31,000 fewer jobs generated in the United States than expected.
Right. So I've said this many times. I'm going to repeat it. If you take the first blush of numbers and look at the amount of revisions and the frequency with which they happen, you can ignore the number and start again and figure out what is the trend.
Oh, I don't know about that, because as we've also discussed, while Canadians tend to revise their numbers higher, the Americans tend to revise theirs lower, so it could be even worse than this.
Except that it's August. And because of the August seasonality, you do get this mixed message. I do believe that the U.S. economy is slowing down in certain areas that people thought were going to be continuing to take this thing higher. Mm-hmm. I think one of the big drivers that people have depended upon has been consumer spending. The consumer in the United States is starting to get tapped again. That's why there's been this big increase in refinancing as the home prices have gone higher. Mm. This is a dangerous path because they've already experienced it, and they know damn well that if we get this price increases for homes accelerating much from here, that type of activity will also cause them some concern in terms of spending.
But we hadn't been concerned in the past on the spending front because we were seeing wage growth in the United States.
Correct.
And that was what we needed to see before Janet Yellen was expected to pull the trigger on a rate increase.
Right.
That wage growth, which we've seen since the beginning of the year, is now slowing, and we still haven't seen a rate increase.
Well, what's been happening, of course, is the denial process of central banks, in other words, to raise rates globally. So we've got this wonderful party that's been going on since 2009. The reality of that whole situation is we've never really produced real growth. And what I mean by that is, given how long you're into this recovery, the amount of money that's been thrown at it, we should have been dealing with a lot higher type of returns than what we've seen. So to go and be happy about, and I know the Obama administration boasts quite heavily about its massive 3% at the top type of growth, but they'll be lucky if they average that when they get through this whole process. That said, there have been new growth areas, certainly in the area that has been lagging, which is the housing. We are seeing now what is the big shortage in the United States, lo and behold, it's construction workers. So we want to do all these infrastructure projects. Whoops, we don't have a whole bunch of people to be able to do that. If we need a bunch of homes to be built, we don't have that. So what you're dealing with is potential for wage inflation coming from the demands, because you got to really raise the money to go and get people to switch jobs at this point.
Well, this is an opportunity, I can imagine, for a laid-off blue-collar worker in the manufacturing sector,
right,
because we're seeing weakness on that front.
Absolutely.
And, this sort of ties back into to Donald J. Trump and the people that are behind him. These are the people who don't have jobs.
And it's true, and there's no question that there's been a big cry for infrastructure. And as someone rightly pointed out today, we can talk all we want about it. Money has been earmarked for infrastructure for the last several years, and that would be several 20 years. And yet it doesn't get to fruition in the United States because there seems to be a siphoning process that never gets the job done. This is a real big issue for the United States. They've got an infrastructure that is in severe state at this point. Whether they fix the bridge today or whether they have to rebuild it is just the question. So there are some real pressing issues. But that said, let's go back to the economy in the United States. And what you should be seeing isn't happening. There's lots of discussion going on about what Yellen has been talking about, where people have anticipated a September hike. I've said to you before, I don't think that's going to happen, and I'll tell you why. Mostly because the economy isn't strong enough to hold it. I know it sounds crazy, but more importantly, the election is a bigger issue. And given the uncertainty and the way that these numbers have been waffling all week, well, I mean, the numbers this week were so confusing. By the time you finished, you didn't know whether to believe them or not because it was the summer, or whether, in fact, we've seen a new trend. Corporate profits, though, continue to be weak. And that's fact, and it keeps on coming out, and that's a bigger issue to me.
Well, how much of that has to do with the fact that the U.S. dollar, that reserve currency that everybody races to as a safe haven, has been as high as it is? Every time you repatriate a profit from overseas, it gets dinged.
Okay, and I don't know, I haven't alerted to people, but if you take a look at a long-term dollar index, the dollar index is way down from its highs.
What do you want, a 5-year or a 10-year?
Five-year be perfect.
All right, we'll pull that up for you.
But the point being that you're down a whole bunch from those highs. So that argument doesn't hold as much as it used to. And obviously, there's not been the repatriation of earnings that's come through in terms of that being in the issue.
Tell Apple.
Yeah, well, that's not showing it as far back as I wanted. Maybe that's all right. That's all right. But you can see it's down from that peak in 2015. So it's on a year-over-year basis. It doesn't show the same thing. My point is that there we go. So we've had it before, and my point is that that's a weaker argument when you look at it from the standpoint of the amount of money coming back in. Where we wanted to see it was in revenues in the United States going up immeasurably. We have not seen that big rise in revenues. So the conclusion from my standpoint is when you look at the overall U.S. economy, it's based on a whole bunch of hope. Hence, we got a weak number this morning. Great. The market's just immediately jumped all over it. The fast money decide we better cover because, boy, it's going to be more infusion of money. Well, the infusion of money isn't necessarily getting the impact in the economy that people have asked for. And I always go back and say, take a look at Japan. It's taken them 20 plus years, and they got again this week. They got minor type of growth, and that's barely going to continue with the type of numbers that they had.
Tick-tock for Yellen and company, though. December is the last opportunity of 2016 to raise the overnight lending rate.
No, they can do it in December, but I mean, the thing is that
sorry, did I say December? I meant December if I didn't.
December. Well, September meeting's coming up is what I thought you were referring to.
Oh, well, who expects September?
Oh, there's lots. Bill Gross and now, company.
What does the bond guru Bill Gross know about interest rates?
Right. So there are a lot of people that are suspecting that was going to be the case and have a high percentage. The Fed fund futures we talked about last week are not telling you that. They're definitely indicating that the more likelihood comes through in December for sure.
And that's a 45% likelihood, I see.
Right, and that's down from where it was. So
yes.
The reality, of course, is it's still being pushed back and pushed by other countries. They continue weak, so will the Fed.
The Canadian economy remains mired in a slow growth environment. We'll get David's take on that when we come back after this short break. The Canadian economy continued to suffer in the second quarter. The Alberta wildfires certainly deepening the pain. For more on this and why the natural disaster can't carry all the blame, David Prince of Harbinger is still with us. And we want to get into that. We also want to look at the health of the manufacturing sector in the U.S. and what it means for us here, because it's tied into WTI, West Texas Intermediate crude.
So I wanted to show people that this thing really does pivot off the price of oil and the American manufacturing situation, because we are continuing to get disappointing numbers on our employment. So one of the things that I wanted to show was this chart that this ISM manufacturing, which came out this week, and you can see it's back into contraction mode.
Anything below 50 means shrinking.
Absolutely. And in the case of West Texas Oil, of course, we've seen it pull back here in this last couple of weeks. So the message I'm getting at is when you take a look at the price of oil, it drives U.S. manufacturing, which in turn drives Canadian manufacturing. And if that's the trend, then those weak numbers that we got on employment in Ontario, which was a disaster for July, next week we're going to get the numbers, and we should probably see a repeat and again ongoing contraction of manufacturing jobs here in Canada.
Well, we looked at the GDP print for Canada. We got some sense of that already.
We sure did, and that was the whole point today. There should not have been such a big surprise. I was a little upset because people were putting way too much on the Fort McMurray wildfire, and yet what people didn't do was to look behind what else was going on, and what else was going on wasn't exactly encouraging. All I can say is, thank goodness the government was spending like crazy, because that was where the bulk of the increase came in terms of the spending. So,
sorry, back up. What did you say? Thank goodness the government was spending?
Well, exactly. We got such a wonderful environment to spend it. Anyway, the point being that we've got a government that just wants to spend, but the real economy is not in the position to receive that type of spending to generate long-term jobs. It's going to be headlined very pretty for Liberal governments because they're going to be hiring all kinds of people. But I'd like to know where they're going to be hiring them, other than the fact that they're going to be holding signs for construction, and as opposed to actually being able to do it, because we have a jobs skills shortage that's becoming ever more prevalent in this country.
And the manufacturing sector in this country as well is dealing with this double-edged sword nature of the Canadian dollar right now. Sure, it's great to sell our finished products to the Americans at the prices that we can charge, but at the same time, we're buying a lot of stuff from the U.S. to make those products we're selling them in the first place.
Okay, so that's the auto industry. And what you've talked about is another key number that came out this week, and that's what I think is much more concerning, and that is auto sales in the United States are really looking like they've peaked. So if that's the case...
GM said.
Well, you can't listen to GM. I mean, why would you listen to that? Or listen to Chrysler when they made the point to miss wind? But the point being that you're dealing with an environment that is starting to lose its momentum. If that's the case, then that big manufacturing pickup is not going to happen to the extent that the Liberal government believes it will. If you're looking at where we sold parts in terms of the other parts that were sold that boosted that overall number, well, that came from final delivery, or I should question myself on that, delivery of some of the stuff that should have been delivered 3 years ago by Bombardier. So be very careful about how these numbers are given to you. So I'm still finding that the road on the investment side in Canada is still a lot of caution. The economy here is not nearly as strong, and if you take out the real estate, which again we got more signals that are starting to lighten up, then this country really is, because now the bulk of the growth is in real estate and real estate homes, selling, building, whatever, but it really is the key driver of the Canadian economy.
You mentioned West Texas Intermediate crude. What about Western Canada Select and then Syn crude?
And the other point. So let's take a look at those, because this is what the numbers are based upon for a lot of these provincial budgets and some of our federal budget. But when you take a look at it, we are still well down from those numbers of a couple of years ago. I still feel the belief that it's going to go further down in between now and December. We are in the shoulder season. We are going to be looking at less demand. And if I'm correct about more manufacturing being cut back, then we're definitely going to see more of those jobs that need to be traveled to. That's going to cut down on further on the demand.
I was fascinated to learn that you were interested in the story that was going on over in the UK, well, in Ireland, excuse me, with the EU, and Apple. We don't usually talk about these types of topics.
One of my lovely Irish friends said to me this week, he said, you know, it was very funny when Apple went over there, they had 190 employees, and no one complained about Apple getting all these tax breaks from the Irish. Well, now we got a situation where for the first time, the Irish government was refusing to take tax money. So that said, we are in this conundrum. What it does show, though, is governments globally are still desperate for money. What was asked for by the EU was much larger than what anybody anticipated.
Apple said they just made it up out of thin air.
Of course, but it's a headline-grabbing number. It makes them appear good. Good luck on collection. But it does scare you in terms of evaluating companies because you now have big tax uncertainty. You've got all that $2 trillion that are sitting overseas. How much will ever come back? The anticipation is a great deal, but that may not be the case.
It was suggested to me by a tax expert in Dublin, Trinity College, who had said to me that if you're looking for someone to blame for all of this, don't blame the European Union, blame the Americans for 5 decades of bickering between the Democrats and the Republicans over the future direction of taxes on the corporate level.
Well, trust the Irish to get it right. I would agree. I mean, there's some truth in that. And unfortunately, what we're dealing with is uncertainty. And again, how do you evaluate stocks when you're supposed to be looking at future profitability? It's impossible with the current situation, and I don't think it's going to be resolved in the near term.
You going to buy one of those new iPhone 7s when it's announced next week?
I don't see any need for it, Michael. I just remember I bought the top of the 6S, so there you go.
You are not contributing to the global economic recovery.
Oh, I think I am. I've spent enough this week. Sorry.
David, thank you.
Thank you.
David Prince is the founder and president of Harbinger Capital Markets Research.
Okay, folks, we'll go to a break, and when we come back, Rob McClister, founder of RateSpy.com, and he talks about how a tax on foreign home buyers sunk Vancouver real estate prices. And he's in conversation with Michael Hainsworth of our affiliate BNN, and that will conclude today's show. Stay with us. You are listening to 580 CFRA.
You're listening to Money Talk on News Talk 580 CFRA.
Joining us from Toronto to talk about the broader implications of today's Vancouver housing numbers, we turn to Rob McClister, the founder of RateSpy.com. He joins us via Skype. Good to have you with us again.
Hey, Michael.
Not much of a surprise here that we saw home sales drop as much as they did?
Well, home sales have been trending down for a while. The biggest surprise from the numbers today were average home prices. Average home prices get downplayed continually on the realtor by the realtor analysts that look at these numbers. The fact is, this is one scary chart that I just saw here with average home prices down almost 20% from the high.
Do we extrapolate any of this into the Ontario market? And when we say Ontario, of course, we mean Toronto.
Well, prices have been softening in Toronto as well. Not to the same extent that we're seeing here in Vancouver. But Vancouver there is so much psychology driving this market, and this 15% foreign home buyers tax is just a kick in the face. It was bad timing. I mean, the market was going parabolic. Sales have been slowing down. This was not the time for this intervention.
In what way? Do you see that it's not having its intended effect, or do you think that Vancouver, the province, ought to have just sort of stepped back and let the invisible hand of the market guide us?
Well, there's a lot of fear that prices are going to keep going up to levels where, they're going to precipitate a crash. The price increases we've seen here on the average, price of a upper end home in Vancouver are just stratospheric. And, when that happens, high prices bring out sellers. And when prices drop as much as they have in the average home price, that brings out sellers too. So we're going to be eagerly watching the number of listings here in the next few months.
Were you eagerly watching the U.S. Jobs data? We were expecting, if we got the 180,000 net new positions in the United States, that was all but going to guarantee an interest rate increase by the U.S. Federal Reserve by the end of the year. That, as we know, filters into the bond market, which filters into our bond market, which filters into your mortgage rates.
Yeah, the guaranteed rate increase in the U.S. has been being pushed forward here continually. So who knows how guaranteed really is. The fact is that, interest rates have been a material factor in driving up home prices in some markets. And right now it looks like rates are going to be stable for the foreseeable future. If I had a gun to my head and I had to pick which way they're going to go, I would guess that they'd go a bit lower. But I don't think we saw today or this week on our site 1.99% 5-year fixed rates. I don't think you're going to see significantly lower than that anytime soon.
To what do you attribute the decline in the cost of borrowing for a home?
Well, I mean, the economy's soft. Right. So exports are weak, and business investments weak. People realize that our economy is in struggle mode. And, so you're not going to see barring, an unraveling of the bond bubble here. And I think there is some bubbleness in the bond market. I don't think you're going to see a significant increase in rates anytime soon.
So it sounds like the issue on the supply and demand front, when we talk about mortgage rates, is on the demand side of things. The cheap money is going to continue for some time. For how much longer do you anticipate it?
Well, I am not a genius rate predictor by any sense. I don't think anyone is, but I don't see anything economically in terms of economic growth. I mean, we just saw a horrendous number in Q2. We'll see a rebound here in Q3, but in terms of growth or inflation risk, I don't think anyone sees any significant risk there that would drive rates higher. You saw a Reuters poll of, the first Bank of Canada rate and the next Bank of Canada rate increase in 2018. There's a very good chance that number or that date could keep being pushed out.
Okay, so as we go into the long weekend, your cocktail party question is, do I lock in or do I ride rates higher? It sounds like, if you don't expect a lot of movement, that riding rates higher might be the most cost-effective solution?
If you can get a 5-year fix near 2% and then not have to worry about your mortgage for 5 years, I mean, there's a peace of mind and convenience factor there. But if you want to play the historical numbers and you're looking at the IMF, OECD, all these organizations are predicting 2% long-term growth in Canada. That's weak. And so that's not the type of growth that is going to be driving rates materially higher in a sustained fashion. So if you want to play the numbers, you're looking, if you can find 1 and 2 year rates around 1.79 or 1.89, that's pretty compelling too. But to pay 20 or 30 basis points more for a 5-year fixed, you can't be faulted for that.
Rob, we appreciate your perspective and insight as always. Thank you again.
My pleasure, Michael.
Rob McLister, RateSpy founder and art aficionado.
Well, folks, that's it for Money Talk. Just to conclude, during the week, the Prime Minister has been in China doing a bit of horse trading and playing basketball, and who knows what will come of those negotiations. And then the debate about whether the Fed will raise interest rates goes on. We had poor jobs numbers, as you've heard, from the United States. And productivity there is not robust. So it's unlikely that we'll see an interest rate hike before the U.S. election. And any interest rate hike will be moderate because, let's face it, everybody's hooked on debt these days all over the world. And interest rates are the linchpin to the party that's ongoing. And my favorite metals, gold and silver, bounced on Friday after having consolidated for the past couple of months. We're heading into the U.S. election, which we have to be concerned about because, as we know, populism is alive and well, and we saw what happened in Britain with the Brexit vote earlier in the summer. The price of oil has pulled back from about $50 U.S. a barrel to, give or take, $45 U.S. a barrel, and that, of course, is reflected in our Canadian dollar. I've watched markets for a long time, and I am just bamboozled by the current surreal world that we live in, and It's very hard to make predictions, but one thing I do know is that investors need to have some defense on board to protect their portfolios. We'll be back next Sunday at 2 p.m., and I hope you're having a great holiday weekend. Thank you so much for joining us. I'm John Budden, and you are listening to 580 CFRA.